Welcome to Peerpoint Perspectives, the securities finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Peerpoint Perspectives is brought to you by the consulting team at Peerpoint Financial. So now, over to your hosts.
Hello and welcome to Season 2, Episode 2 of Peerpoint Perspectives, the Art of Securities Finance. I'm Roy Zimmerhansl, and I'm clearing my throat, and I'm your host today. Before we get started, I should say that the podcast is for information and entertainment purposes only. Nothing you hear on the podcast should be considered as investment advice or be relied upon as the basis for investment decisions. Before making any investment, you should speak with a qualified investment professional. I'm not one of those, and I think my guest would agree that you should seek advice elsewhere. Now that my lawyers are happy, I can get on with the episode. My guest for this episode has an educational background in engineering and computational fluid dynamics. So of course, it was a natural progression to move into derivatives and synthetics. He's held senior positions at Deutsche Bank, where he was instrumental in the launch of DBX trackers and Macquarie, and is currently an advisor to BetaShares, one of Australia's leading ETF providers, and also runs his own firm, Portable Beta. In fact, when I was putting together these notes, I recalled that I actually sat next to my guest for a time when we both worked at Deutsche Bank 15 or so years ago. So without further delay, let me introduce my guest and welcome him to the program, Dr. Roger Cohen. Hello, Roger, and welcome.
Hi, Roy, and I guess it's good morning to you, although it's almost sunset here.
Yeah, so good morning to me and good evening to you.
Good evening. And yes, I do remember sitting next to you at Deutsche Bank, I would say almost fondly.
Yeah, one of the interesting things that I recall is that you're one of the few people that I recall actually that would sit at their desk and think about things while the rest of us were busy scurrying around. So I guess that's
or sleeping.
Well, you know, I worked at a Japanese bank, and I'm definitely used to some colleagues taking naps on the trading floor. So it wouldn't be unheard of. So you are the first person on the podcast that I've actually worked with other than my current colleagues at Peerpoint. And you're also my first guest from Australia. So there you go. It took me to season 2 to get down under, but I eventually got there.
Excellent.
Right. So I really want to talk about a few different things today, Roger. And really the first one is ETFs. So you've had quite a long experience in that and background. So maybe you can just sort of walk us through your own history and how you got involved, where you went and what you did then, what you're doing today.
Sure, Roy. So I guess the first exposure I had to ETFs was when I was at Deutsche some sort of 10 to 15 years ago. And I was running a Delta One business. If you think about it, in Delta One, we do, equity swaps and forwards and all sorts of things, focused around indices. So we're trading indexes. Customers want exposure to indexes or baskets. And so kind of that business kind of morphed into what can we do to create a product that is transparent, that can trade easily on exchange, that doesn't rely on moving baskets of stocks, is simple, et cetera, and that, ETFs, I think at that stage were just taking off in Europe. They were pretty well developed in America, and we started up the DBX trackers platform.
Right. And so what was really, so the interesting question, I think, at that time was, should it be an investment bank product or should it be an asset management product? And I think there was quite a lot of collaboration between the investment bank and the asset manager at Deutsche. So can you maybe take us through some of the thinking there?
Sure. So I don't know if you remember, but originally the asset manager at Deutsche had 2 ETFs. I think it was a DAX and a Euro Stocks, which were both physically replicated, and they hadn't focused much on them. So I think there was 50 or maybe 100 million euros of assets under management and no sort of structure or marketing around it. Meanwhile, in the bank, we had a platform that was pretty sophisticated for trading indices and baskets. And so we developed initially the synthetic ETF structure. So basically, we did collateralized equity swaps with an entity being the asset manager, and that was the kind of the back end or what powered the ETF. And then wrapping that into a fund meant we could deliver the economics very cheaply and efficiently, and the asset manager we could create an asset management product. Initially, we ran that all inside the investment bank, and then over time that migrated out into the asset manager. So initially we were kind of powering the swaps and just using asset management for distribution, and then it kind of turned 180 degrees where it was all driven by the asset manager.
And was that because the investment bank and certainly had a strong position in derivatives? That was one of Deutsche's real axes at the time. But was that because eventually it was seen that the universe for investors using it would be larger, there'd be a broader appeal to the wider audience, and therefore distribution through the asset manager made more sense?
Yeah, if you think about it, the end user of an ETF is an investor, and asset management businesses are better placed to serve investors, and investment banks are kind of the wholesale piece to that. So it was a very good relationship and a good fit.
Right. And you talked about it being relatively early days for the European industry, and there was this real sort of challenge as to whether we should go synthetics or go physical. And there was a lot of debate and a lot of jockeying, a lot of back and forth on that. Maybe if you can, I don't know, maybe pull out a few of the highlights in what the debate was about back at that time.
Sure. So there's advantages to both, I guess. Physical is that what you own is just a basket of stocks, and the basket replicates the underlying exposure. Whereas in the synthetics, what you own is either cash or some form of collateral, which could be stocks, but not necessarily the stocks that you're exposed to. And then a synthetic or a derivative, usually a swap, is used to provide the economic exposure. And that's, from an exposure point of view, it's very efficient because the investment banks run large books. They can deliver index betas very, very cheaply, very efficiently, and they can optimize to deliver the best exposure. And then if it's collateralized properly, the end owner owns a derivative which gives them the economics, and they own some form of collateral, usually stock, which means that they're not exposed to credit risk, or they're exposed to very minimal credit risk. So it's actually, in my opinion, a robust product. And it was a little bit sad to see that over time, I think with people's paranoia about derivatives and some of the sort of the information that went around the market, there was a big swing towards turning synthetic products into physical. Now there's a bit of a resurgence of synthetic products, and I think especially institutional clients are realizing that as long as their exposures are collateralized properly, it doesn't matter whether the economics are delivered physically or synthetically. And so the efficiencies of running synthetic products are starting to rear their head again.
Yeah, I guess synthetics, if you leave aside ETFs originally, one of the benefits was that was the only way that you could get exposure long or short to some markets, and it was really the only access point. And then it was kind of taking those kind of features and then saying, can we actually hit target returns more effectively with synthetics? And so really that was one of the issues. But as you talk about it, the reality was the concern that I'm buying this index, but I'm being collateralized by assets that have nothing to do with it. And the interesting thing for me is that the synthetic ETFs really led the way in transparency in terms of having the look through in terms of who the swap providers were and what the underlying collateral was, that still kind of sets the standard today.
Yeah. And ironically, sometimes the collateral was, as good or better in quality than the underlying securities, because the focus on collateral is stuff that's liquid, it's easy to move, it's cheap, and it's generally, major index securities. So you could have for example, a small cap emerging market ETF, and the collateral could be, Japanese main index stock.
Yeah, of course, those things go both ways, right? They, because there's no sort of legal requirement or regulatory requirement in terms of what the collateral is, other than perhaps an absolute level of collateralization. You can have, it's down to the individual provider. So I would always caution, and this also applies to physical ETFs that actually lend securities out and take collateral, that you need to really have an understanding of what that underlying collateral can be. So it's not about synthetics, it's about any kind of collateral that you're taking for any kind of collateralized transaction.
Yeah, it's the question to really ask is if the asset manager or whoever's providing the product disappeared, what would you end up with?
Exactly. And that, that goes to a lot of different themes, one of them being, if I can end up being the owner of this as collateral, is it something that I could buy as an outright investor? And what we've seen in some of the crises over the many decades is that occasionally people end up with collateral that they could never have purchased themselves. So that's really the key test, as you say.
Yeah, the key test is really, can they sell it? Because when they get that collateral, they usually want to get out as quickly as possible.
So practically that is it. But legally, investors, there is a transition point. I got into this debate with the central bank. Central bank wanted to lend their securities. The securities they had were not all that attractive. They could get some traction, but I said it'd be more attractive if you can if you can take equities as collateral. They said, well, you can't, we aren't allowed to hold equities ourselves. And I said, yeah, but technically it'll only be for a nanosecond, because if there's a borrower default, we'll end up effectively selling those on your behalf. And we'll do that by buying them onto our own balance sheet before we sell them into the markets. So it's really just momentarily. And they said, if it can be on our balance sheet for a nanosecond, we have to apply the same standards. So
yeah, understand. Absolutely.
Practically, you're right. It's about the liquidity of the collateral. That's why, I've argued many times in the past with customers about equities, where they say, well, equities are more volatile, particularly in a crisis point. And that's true. But I always argue that, first of all, if you're lending equities and taking equities as collateral, the likelihood is that in a crisis, they're both moving in the same direction. So it's about the relative movement. And you can't really have a huge market crash without a lot of buying and selling activity. And so, in fact, liquidity of equities goes up. Whereas often you can see some of the high quality liquid assets actually freeze because anyone that owns them doesn't want to sell them. They're happy to be positioned that way. So the liquidity can often tighten for very shortened periods of time.
Absolutely, yeah.
So tell me about what you're doing now with BetaShares, and sort of the background, how you got involved with that, what it does, and what you do now, and sort of taking it to ETFs today and your direct involvement now.
Sure. So I've been involved with BetaShares right from the beginning of that business, before they ever listed an ETF. And that involvement started when I'd finished at Deutsche Bank, and I was back in Australia on a holiday, and one of the principals, who I've known for many years, had a coffee with him, and he said, "What do you know about ETFs?" And having run the X-Tracker platform at Deutsche, I gave him quite a long brain dump. And then he said, "You need to meet my partner, who is Alex Vineker, the current CEO of BetaShares." We had many conversations while I was in Sydney, and then I went back to London, and I was on Skype almost every day with them. And they decided to set up an Australian-based ETF business tailored for the Australian market. And I think that's where they were very, very clever and insightful, because Australian market's relatively well developed. It's got a large superannuation or pension base and reasonably sophisticated investors, but it's also got some quirks around its tax system and the regulatory system. So the other players in this market tend to be the big players who port their technology from offshore into the market, whereas BetaShares, they really look at the market and said, how do we design a product from ground up to suit the market? And we took a sort of a supermarket approach where we said, what exposures do investors need, and what exposures do they have that can they not get efficiently? And we kind of built a set of products to fill all those gaps. So we didn't go into the spaces where there were large, broad market, commoditized products, because that space was well filled, but we went into niches with themes. We went into fixed income, we went into offshore exposure. We've got short and leveraged, and we're really trying to fill the shelves with a complete range of products so that investors have a tool for every exposure or every situation that they want.
Right. So talking ETFs while you're on holiday sounds a bit of a busman's holiday, as they actually as they describe it here. So
correct.
Well done. So look, one of the things you've talked about there is talking about different themes or different asset classes. So isn't there a danger there of just following hot themes, and by the time a product's developed, the value in it has disappeared? Or how do you talk about that a bit?
Yeah, look, it's always a tough one, because if the way I think about it, we have a product development list, and it might have 50 things on it, because every day someone's coming in and saying we need oil or mid-cap emerging markets, and you just write it down somewhere, and then you order them by priority, and really only the ones in the number 1, 2, 3, 4 are the ones that are going to go onto the launch pad, and the rest of the time you're just constantly moving all these others into position, or getting rid of them. But it's always worth hearing what people want and just making a note of those products. And then the other thing is, of course, some products are your core, your betas for markets or for sectors, or part of the capital structure. So they are going to be products that are constantly growing in assets under management. People hold them for a long time. Then you have thematic products. For example, we had an oil ETF which sat doing nothing for a long time. Then when the oil price started moving, 2 years ago, that was hot, and it was good to have that in our armory. And the same now with current market situations. Short products, leveraged, geared products are all becoming very, very popular, because people want to be opportunistic and they want to be able to get into the market with a fairly tactical exposure. So you have a mix of long-term products that are going to be around, be in people's portfolios all the time, and products which will come and go.
Yeah, so it's the thing that's always appealed to me about ETFs is the whole ability for an investor to construct a portfolio that looks the way they want it to, right? So as you say, you're going to have some core pieces in there that might be just pure index trackers because, markets rise over time. But opportunistically, you want to say, I think technology is a hot market, and I just read something about one of the BetaShares technology funds being the best performing ETF I think this year. So congrats on that.
Yeah, and the great thing is, we don't pick stocks. We just had the right product at the right time to capture that when that was a hot sector. So it's a great example of how an ETF works.
Now, you talked about briefly the geared and leveraged and short funds. So maybe let's talk about that, because I know people that trade some US ETFs where they trade the tickers and they literally have no idea what the underlying is, because all they know is they're really volatile stocks and they love trading them, which I think is just crazy.
I tend to agree with you, and the analogy which was written up in a recent interview I did is it's when markets are volatile, you have professionals, and it's like taking your everyday town car down to the racetrack and competing with professional drivers. And even if you're really good, they're going to beat you because they're driving Formula One cars and you're driving your city car. So they've got better machines than you. So that's my caveat about volatility. I think leave it to the professionals who can trade in the physical, in the derivatives, and all the different markets, unless you really know something, or unless you're just punting and you're saying, I'm just going to have a swing or a bet, but can lose that.
So what's the application for them then? Where do these funds sit in terms of an investor kind of portfolio, and how do your customers use them, or BetaShares customers use them, or what do you think the place for them is?
I'll give you two examples. So one is what I call sensible gearing. So if you have $100, you could go out and buy $100 of equity exposure, and over time that's going to grow and you'll get the returns. Or you could say, I want $100 worth of equity exposure, but fixed income is a really good diversifier to equity. So why don't I put $50 of my 100 into a geared ETF? So that $50 gives me $100 of equity exposure, and then put $50 into a big fixed income benchmark, and that gives me that diversification, which performs very well in a crisis, a risk-off type scenario. So over time, I get my long-term equity returns. I get some positive return from the fixed income, and I get that diversification, which comes into play over times of stress. The other thing with the geared product is, unless you have a strong view, it's not a one-shot product, because if you buy a geared product and the market drops by 40%, you'll lose 80% of your capital. But if you think of it as something, if you're gearing sensibly and you buy regularly, then over time you will buy the dips as well as when it runs, and you'll find you get the benefit of the gearing. So that's kind of what I call a sensible approach to gearing. Use it to make your capital more efficient, and use it as a regular investment vehicle. Then the effects of volatility diminish.
That's interesting. One of my recent LinkedIn video posts, someone asked me about dollar cost averaging. And the most recent application that I've seen talk about it was actually related to Bitcoin. So I suppose it's not all that different to what you've just described, where if you're making regular investments into a geared fund, you're getting it geared when things are going well, and geared when things aren't going so well.
Yeah. If you're a year out from retirement, putting everything into a geared product would be terrible. Imagine that you were retiring just before COVID. It would wipe you out. So you've got to be sensible if you're using gearing as part of your accumulation strategy.
So I'm also interested in, if we're talking about trends, do you have any thoughts on ESG? Again, I think that's been a big theme that we've seen our customers talking about in the securities lending world. And, I'm kind of just personally, I've also got an interest in a platform that is looking to help raise money for startups and scale-ups, where the USP or the angle for investees is they either have to be Sharia compliant or they have to pass an ESG screening test. So what are your thoughts on ESG? I guess just generally in the investment market, or specifically with respect to ETFs?
I think my prediction is ESG is going to become a mainstream screen. So at some stage to be included in a major index, and I'm talking S&P 500 or MSCI World, the big names, not only are you going to have to be a listed company with large market cap, et cetera, I think you're also going to have some kind of ESG compliance. And I suspect at some stage, one or more of the big index providers are going to move in that direction, and the big asset managers are very ESG focused, so it will align with their own aspirations. I think we are as global citizens, we really all are responsible for making sure that our world is left in a good shape and good hands. So I think it should just be part of governance for every investment. And from an economic point of view, if you're sustainable and efficient, you will probably generate better returns.
Yeah, well, let's hope so. I made the comment myself recently that, look, I don't know whether ESG is a fad, but what I'm pretty confident of is if companies don't take a different approach to the environment and their impact on it, we're not going to have much of an investment community left. right? So,
Yeah, I would agree with you there, Roy.
So do you guys have any ESG focused funds, or where does that actually fit into the product?
We're actually one of the leaders in Australia. So we have two equity funds, a local and a global one, and we also have a bond fund. So it's definitely an area of focus and something that we're very interested in.
Well, I want to lead sort of into a related area, because when we talk about securities lending, short selling, equity finance, that kind of space, which you've had a lot of experience as a user of, one of the things that always comes out is a discussion on whether short selling is ethical. So what do you think? What do you think about that?
Look, my anecdote about that is I was in the pharmacy the other day and had a prescription filled, and I noticed that they took my prescription and someone went racing out of the door, and I said, what's going on there? And they said, oh, don't worry, we're just going to borrow. We don't have what you've got a prescription for. We're just going to borrow it from the pharmacy down the road. And someone went running down the road, borrowed it from the other pharmacy and gave it to me. So short selling filled a need. I didn't do anything unethical. I didn't create, I wasn't anti-patriotic. I didn't cause the market to go down. It just managed to get the liquidity that I needed to get my product with minimum impact. So short selling is not evil. I think it's construed as evil because people think, you're selling something you don't own and pushing the price down. It's the same as borrowing money to buy things. You don't own them as well, and you're buying them to push the price up. So I think it keeps the market symmetric. It gets rid of bubbles, and it's something we all do when we in that situation where someone has to borrow something to fill an order, or when you pre-order an iPhone. What's Apple done? They've been short selling iPhones until they can deliver them to you, in a sense. So I think short selling has a much worse name than it really is.
Yeah, I regularly post things on it, and almost inevitably those are the ones that get the most engagement. So we'll see about it. I keep saying it's been around for 400 years, and there's been debates going on about it. So I'm reasonably confident that 400 years from now there will still be debates going on. So we'll see. But you guys offer bear funds. So maybe explain what a bear fund is and how it operates.
So a bear fund is just simply something that does the opposite to what the market does. So when markets go up, bear funds go down in value, and when they go down, markets go up. They're created by having a short exposure inside the fund, usually using futures, because it's a more efficient and easier way to short a market. And again, with caveats, obviously over long-term markets go up, so you wouldn't hold a bear fund in your long-term accumulation portfolio. But if you want to take some risk off the table without selling investments you've had for a long time, because you may have capital gains or you may like those investments, a bear fund's a great way to hedge. And if you really have a strong view that things are going down over the short term, a bear fund is a great way. Without them, the only thing you can do is get out of the markets. With a bear fund, you can actually take advantage of that view.
Yeah, and what a lot of people don't realize is that usually the amount of short selling based on value is actually at its highest when markets are at their peaks of a bull market run. For exactly that reason, people are actually hedging exposures. They're happy with their portfolio over the medium to long term, but they're concerned about where am I if something happens in the next 6 months.
Yeah, I absolutely agree. So, and I think to keep markets efficient, to keep bubbles from developing, to keep them symmetric, you have to have an efficient way to short sell.
Yeah, it's quite interesting. I read something from, and there's been quite a lot of exchange on LinkedIn about this, but from a well-known portfolio manager, a senior person there, who questioned the value of price discovery. Is it really important? And just sort of, if I'm not mistaken, that's the purpose of a market, is to get sort of cumulative price discovery. But maybe it's me.
But if I'm wrong, that's an interesting one.
So have you, in your career, have you been involved with sort of physical stock short selling? So rather than just using futures, have you been a borrower yourself?
I have, yes. I mean, some of the products we ran at Deutsche and elsewhere were physical short selling products. So I have, and I've seen those markets operate very efficiently.
How do you compare sort of doing it via futures versus, say, the physical markets or the individual stock level? Any comparisons?
Look, futures are a very good liquid instrument for a large exposure. So in a sense, they're a blunt instrument, but they're efficient and they have low transaction costs. Whereas short selling a single stock or a basket of stocks gives you a much finer and a much better short exposure to whatever you want. It's just like being long on its head. If you want an index, you can buy an index or an index product, and you could short a future. If you want exposure to a large cap tech stock, you would buy a large cap tech stock. If you want a negative exposure, you would short an individual stock.
Yeah, and I think that's a good example, and that's always in the debate between single stock futures and the underlying physical equities. You're always going to get a broader universe of being able to trade the physical markets, because you're not going to have the volume or the activity or the interest in a huge range of single stock futures. Yeah.
Also, basis futures do trade away from fair value. They're not perfect. So shorting stocks gives takes away the basis risk. And the other thing that's useful is, I like the index, but I don't like telcos, or I don't like a certain sector at the moment. I can hold my core exposure and I can tactically hedge by shorting the parts I don't like.
Yeah, I mean, and again, people use that over the short selling ban period in some markets to get short exposure to financials, which they couldn't get otherwise.
I've had that conversation with certain regulators and others.
Yeah, and of course, since then, many regulators have actually said, well, no, it's now about short exposure. However you come by that short exposure, we don't want you to have that short exposure. So it kind of takes away from that. So I'm curious. You also gave in on your website. And this happened before I used it. In 2015, 2016, I was presenting in India, and the head of the insurance company regulators gave this example about securities lending and property. And I've been using that example ever since then, right? Anyone that's taken any of my courses or seen me do any introductory presentations, they've seen me use that. But you actually predated that, I think, by a couple of years. So why don't you take us through that example? Because I think it's a fantastic comparison.
Thanks, Roy, and thanks for giving me credit there. I think about it as, if you own a property and you don't live in it, you have it as an investment, you bought it because you expect the price to increase. That's fine. But if you leave that property empty, you're actually not maximizing the income or the utility of the property. And you're in a sense being, if you're running it for an investment fund, you're actually neglecting you would be told you're neglecting a fiduciary responsibility, because you should be renting that property and getting an income from it. The same should be true of securities. If I own a portfolio of securities, I own them for the long term when they're going to go up, and I get the dividends from those securities. But if I can rent them out, I can derive extra income from those securities. That should be in the benefit, to the benefit of my investors. And exactly with the property, you have to manage the risk of your tenants. So you want good quality tenants who are not going to trash the property. And you do that by taking a security bond, by screening the tenants, by inspecting the property. The same when you lend securities. You make sure you take good quality collateral, you mark to market daily, you mark to market, and you settle the differences. You're in the same position. So I would argue it's almost a fiduciary irresponsibility, if that's a real word, not lending securities out if you are an asset manager that has assets that can be rented for a good risk-adjusted return.
Yeah, and I think we make the same argument in a slightly different way, but to the same endpoint, that investors need to have a considered opinion on securities lending. Whether they do it or whether they don't do it, they need to have a clear policy as to why they do or don't. But the point is, they need to be able to demonstrate that they have looked at the options and determine that it does fit or it doesn't fit for their funds.
Yeah, I guess you could say the same with property. You could choose not to rent it because it's in pristine condition, or because it's in terrible condition, it's going to fall over if people occupy it. So it's you can make a decision on its merits, but you need to make that decision, not just don't do it.
Yeah, and again, the thing that we argue is that securities lending is a low risk business, which generates a consistent low incremental return, which accumulates over time, and particularly for long-term investors, the fact that you're getting a positive contribution from securities lending year in, year out, save when Lehman defaults, if you haven't got those safety mechanisms in place, you may be a loser. But the vast majority of investors that act prudently, that have the kind of governance that you talked about, that might also have indemnifications from their service providers, means that the risk is pretty low, and the odds are that it will continually generate positive returns in up, down, or flat markets. Correct.
I absolutely agree with you on that.
And that same kind of theme for long-term returns, I think, I've been part of a delegation to the EU where we talked about the positive contribution of lending to lessening the state burden for retirement. And I know retirement's an important issue for you personally, I guess, as well as professionally. So to take us down your thoughts on that direction.
You're referring to my age, I guess, in that latter statement.
No, look, one thing I don't ever joke about is age, right? Age is a myth.
Absolutely. Yeah, no, retirement is very important to me, because I guess that's, for myself and for most people, we are trying to provide for ourselves, for a time where we will be, we finish work and we've got a long time horizon to enjoy. And so I am very focused on creating products or outcomes that can give retirees the best possible outcome in that respect. So that's building up, accumulating wealth that they can use through their retirements. We're pretty lucky in Australia. We've got a good not a perfect superannuation system, but we're relatively well off on a sort of global scale. And individuals are reasonably well attuned to the fact that they are putting money away all the time for their retirement. And I'm very, very much concerned and involved with trying to make that system better.
Yeah, and Canada is very much the same. So I'm, I left Canada, many moons ago. But even then, one of the issues was that the pension schemes were gathering up so many assets because of the restrictions on investing outside of Canada. They were possibly distorting prices. So once you do stock markets and then bond markets and then start buying all the real estate, you run out of things to buy, and you end up sort of trading against yourself almost. And then eventually things opened up, but only reluctantly. So the fact that you're accumulating assets, I think, is a good thing, but you also need to be able to deploy those assets. So if Australia's been doing this a long time, and they have, what are your concerns? Like, what are the challenges?
Well, I think some of the challenges are around, what I would call in some ways tweaks. There are anomalies in the system here. So we have a government pension, which is means tested. And that creates some strange outcomes. For example, if you've got no pension assets, you get a government pension. If you've got none of your own superannuation. If you've got lots of superannuation, you get nothing from the government. And then there's a zone where it tapers out. And this creates for some retirees, it creates it's like a fake tax, because for every dollar your income increases, they take away 50 cents of pension. So people near the bottom are effectively being taxed at 50%, which encourages, irrational behavior. It says either spend it all and then you have the cushion of the pension, or put it into high risk, go to the casino, try and double it so that you get out the other side where your dollar's worth a dollar again. So there are things like that can be tweaked. But overall, in a global perspective, we do have a very good system.
One of the things that I remember, I was running a conference probably in 2010 or 2011 maybe, and I recall asking the keynote speaker, who was COO for a major UK asset manager at times, like how do you square the circle of a market that wasn't generating really the long-term returns that are used in sort of the annuity forecasts to be able to hit those kind of benchmark returns? How do you square that circle with a growing, aging community that is living longer? And these things don't seem to add up. The investment returns aren't what they were in the good old days when I had hair. And but people are living even longer now. So how does that actually ever resolve itself?
It's a tough one, and I think one of the things the Australian system did is it moved away from defined benefit schemes. So essentially, it took the risk out of the system and put that longevity risk back onto the individual. And I think now with technology and with good oversight, I think we need to start looking at very well run defined benefit schemes again, to take longevity risk, to give retirees a good longevity risk management product. So my view would be we need to partition our retirement savings into a kind of a defined contribution part, which can be invested along the risk appetite of the individual retiree, and a defined benefit part, which is going to manage their longevity risk.
Oh, I see. Because I've heard you talk about this. So do you see that defined, because you might be the only person I know that's actually talking about a return to defined benefit. Do you see that as kind of being a government run thing? Like, is that how the government would support it? Or are you still talking about sort of commercial?
No, I think commercial best of breed within a tightly regulated framework. And perhaps, with some kind of government backstop. At the moment in Australia, the government backstop is the pension. So if you think about it in that context, and you think if the government's going to spend a certain amount of money, how can they do it to make the system more efficient and more robust and make the outcome better than it is at the moment for everyone? So I think the government is probably a good provider of longevity insurance, or underwriter in some sense, but I think the private sector can run best of breed funds better than the government.
You've kind of moved in your career between Australia and the UK. Do you have any kind of observations on the difference? Because the way that I've looked at Australia and having spent time in Asia, I can see that it's really Australians that have brought derivatives all through Asia, and so presumably it's different in the UK and Australia, and so you've been there, here, and then back there again. Any thoughts?
Look, I think Australia has a lot going for it, and I won't make reference to the weather, but it's a reasonably well-developed economy. It's relatively uncrowded, good quality of life, and a lot of benefits. But it's also not the centre of the universe. And at time, having when I left Australia, I thought Sydney was a big city, and each time I came back while I was living in London, Sydney got smaller and smaller. So it's big, but it's not the same as some of the global cities. Right now with COVID, that's working to our favour, but in general, I think the centre of the world is not Australia.
Yeah, I remember the first time I went to Toronto International Airport when I was 8 years old, and I thought it was the biggest building in the. I couldn't imagine a building bigger than that. And then I actually flew somewhere and realized it wasn't really all that big. So yeah.
Yeah. Have you ever gone back to your high school?
I did. Before I moved to the UK, I went back. We had a reunion from my junior high, and I remember thinking that I knew it was sort of a medium-sized school, and now it's like. And then when I went back, and it had expanded pretty significantly, and I thought, well, that's only a little bit bigger than a few porta cabins, really. So,
yeah. It's like your airport. I thought my school was big, and it's really small.
Yeah, true enough. One of the most interesting pieces of work I've seen you do was actually was earlier this year, possibly the highlight of my 2020. Which was your quantum theory of toilet paper, which I saw on LinkedIn. So maybe you can take us through that fascinating piece of work.
Oh, look, it is fascinating, isn't it? I think when your whole world is disrupted, and suddenly you go from commuting to the office and spending most of your waking hours in an environment to sitting around at home, as well as continuing work, which I was very lucky to be able to do. I kind of looked around me and thought there's a lot of good stuff going on here, as well as the bad. And the good was people were relatively resilient. No one actually ran out of toilet paper. And local industries began to develop. Local where I live, local cafes and restaurants that could no longer serve their customers started distributing goods from their own kitchen. So you could buy supplies, and you could buy, commercial kitchen grade pasta sauces and things like that. And they became quite enterprising and also quite community focused, because they really appreciated the business they were getting from their local neighborhoods. But I wrote that piece when when COVID first, we had the lockdowns, and the first thing that disappeared was toilet paper. I thought, gee, if I was really under stress, I wouldn't be buying toilet paper. I'd be buying food and water and all these other things. Why is everyone focused on toilet paper? But it developed a life of its own, where the supermarkets either had none or the shelves were completely full. And so that was the genesis of the quantum theory of toilet paper. It either exists or doesn't, and there's nothing in between. But I'll plug that. Read my blog if you want to actually see the piece, which got published in Sci-Fi Lampoon as well. So.
Okay, well, we'll make certain that we include a link to that, because I found it fascinating work. And is that an ongoing thing? So you suggested that was early work. So
interesting you say that. If I had time, and maybe I'll do it, I think toilet paper can also explain volatility.
Okay, but good.
Now.
You haven't done any. I would venture to say you haven't done anything on that yet, but I don't want to paper over the fact that might be the case. So you've given us some of your thoughts on 2020 in terms of innovation and adaptation and sort of really the human spirit. And then one of the things we haven't really talked about at all today is a lot of what I hear you talk about actually is about the human aspect to it. So the human psyche and how people approach it, and now also sort of the positive sides of adaptation and adjustment. So that scene, although it's not an obvious part of what we do, that is really an important factor in the whole business, isn't it?
I think so. And I think it points to the fact that we are resilient. There's a lot of bad stuff going on, but we're all reinventing. Who's going to go back to the office 5 days a week? I'm not. I'll now get the right balance where I can work at home and I can go into the office. I can get the social or the client contact, and I can also sit at home and focus, or take the dog for a walk in the middle of the day and do other things. So when we emerge from this, I think my quality of life is going to improve.
Yeah, and I think that's probably the case for many people. Sadly, not everyone. I think there's quite a lot of things that are actually worse off today than they were. And I don't know what it's like in Australia. We're just on Thursday. We're recording this on a Tuesday. On Thursday this week, we go into another month-long lockdown. And without necessarily all of the support mechanisms that we had when we went into the first one.
Yeah, no, I don't want to trivialize it. It's a very, very bad and serious situation, and we've got a lot of pain, and the economies are suffering, and there's a lot of difficulty. I don't want to trivialize it, but I think I also want to take out of it or emerge with the positives when it is over, which I'm very optimistic it will be at some stage.
Yeah, and I do think it's a world changed forever in terms of the workplace. So your point, I think your point's well made.
And I have to say, by luck, I'm in Australia where the impact has been a lot less than for you and for many other countries. And I think luck plays into that a lot more than people give it credit.
Well, I've said I don't know how many thousands of times it's better to be lucky than smart. So listen, Roger, I don't know if you have any other sort of closing thoughts that you'd like to share.
No, I think we've covered a good range, and it was good to have this chat. I certainly enjoyed myself.
Right, and if people want to follow you, so I'll include sort of your website in there, but if people want to follow you, what's the best way for them to do that?
I think LinkedIn is probably the best way. And if people want to make comments or reach out, I will definitely respond.
Great. Good. Listen, thanks very much, Roger. And to listeners, I'll be back in a few minutes with my thoughts and reflections on today's program. So, Roger, thank you so much for taking a huge amount of your time. If your day is like anything like my last few business trips to Australia, it should be time for you to be cracking a few tinnies by now.
Hopefully, yes. But thanks very much, Roy.
Okay.
Thanks for doing this, and enjoy the day.
Okay, appreciate your time, Roger. Thanks.
All right.
I hope you enjoyed the discussion with Roger. While he may not be a name you recognize, he has had an important influence on the development of ETFs in Europe, and he continues to have an impact in Australia. ETFs, of course, are an important part of the securities lending industry, but I think it's helpful for market participants to get a solid understanding of ETFs as more than just a source of supply. I think he did a great job explaining how investors can use a series of ETFs to construct core portfolios, but also use bear funds and leveraged funds, the sort of slightly racier versions of ETFs in a responsible way that aren't really always immediately obvious to people. I think Roger is the king of analogies, and I think he shared a few of them with us, and I think they really deliver a clear message when you're trying to explain things. And goodness knows, I've been trying to explain securities lending to everyone for a long time, and analogies are a great example, particularly renting out the house as an analogy. People that have seen my courses, as I said, will have seen me use exactly that same analogy, and it was interesting to see Roger use that a few years before I came across it. The debate between synthetic and physical ETFs goes back to that time 15 years ago. And sort of for the following 5 years, it was always a raging debate back and forth. Synthetics setting the standard for transparency that was followed subsequently by physical ETFs, but definitely physical ETFs won the day on that argument. Interesting to see it starting to make a little bit of a comeback. That'll be interesting to watch, to see whether that continues to be the case. There's, of course, a parallel with synthetic versus cash market prime brokerage. And actually, we have some guests lined up in the coming weeks to address that very topic. So keep an eye out for future shows on that. Roger spent some time talking about his proposals for smoothing out some of the distorting effects of the retirement system in Australia. And, it's not just Australia. I should point out that that same kind of thing applies to other countries. And Roger might be the only person I know promoting a partial return to defined benefit funds, but he is proposing a different approach than in the past. So it'll be interesting to see whether that plays out. Finally, Roger shared his views on the adaptability of people and their resilience in the face of this pandemic, and how, in his own case, he's going to be changing the balance of working from home and in the office or in face-to-face in future. And look, I think that theme comes across really from everyone that you talk to, is that although there's some sad stories, there's also sort of a lot of hope in and faith in people that have adapted. Let me say again, I loved the quantum theory of toilet paper, and I am definitely going to have a copy of that in the show notes. I thought it was hilarious, but also really quite well constructed. So that's it for another episode. And please, I need you to do me a favor. It would really help us get more guests if we had some reviews and ratings. So if you like the podcast, please share the love and give us a review. If you don't like it, that's okay too. I'm interested in your feedback either way. In any case, we have some great guests lined up, and we're always excited about the shows that we have planned for the coming weeks. And I hope you'll join me again. As always, I encourage you to share topics or guests you'd like to hear from. So drop me a line at roy@purepoint.info. Our contact details are always in the show notes. If you haven't already, please subscribe to the podcast and do tell all your friends. We provide a lot of free securities finance content, which you can find at our website at www.purepoint.info. We're very active on LinkedIn, and you can find us on Facebook and even Instagram now as PurePoint Financial Consulting, and on Twitter and actually Instagram as PurePoint FC. I'm Roy Zimmerhansl. This has been PurePoint Perspectives, the art of securities finance, and I look forward to catching you next time.